All right, good evening, everyone. Welcome to MBA 620. This is Project 5. We are in the spring 2020 semester, and we are at the end of the course. Yay! Wonderful. Okay, so Project 5 has to do with financial decision-making for managers. This is the deeper concepts where we will discuss things like the cost of equity, the cost of debt, weight of equity, weight of debt. We'll discuss that all in one formula we call the weighted average cost of capital, also known as the WACC formula, very appropriately named. And we'll also discuss the capital asset pricing model. Both are very deep concepts in finance, especially in business finance, because or corporate finance. And the reason why we discuss these concepts are because as managers, if you ever own your own business or operate a business or a manager of a business, you have to make decisions to raise capital. And when we're raising capital, we look at things like the cost of equity and the cost of debt to make a determination whether we should be raising equity or debt. So the first step, we're going to be discussing the weighted average cost of capital and the weight. And so the weighted average cost of capital formula, there's a couple of components that we need to factor in when we build out the formula. One is we're going to discuss the weight of equity, the weight of debt, and we'll also discuss the cost of equity and the cost of debt. And the formula, the weighted average cost of capital, we actually bring in debt and equity together to discover the weighted average cost of capital. So think of it like a pie chart. You'll have to get to 100% of financing for any company. We have a portion that's assigned to equity and a portion that's assigned to debt, which make up the financial picture of the business, so to speak. So first, let's talk about equity. This is typically represented as shares of stock, and it is an alternative to borrowing at the organizational level. Equity, as you might expect, has a weight, which makes up the total portion of the company's total capital. So the weight of equity in a company's capital, it is calculated by dividing the market value of the company by the sum of the market values of the equity and the debt. So expressed in this simple formula, we take the total equity here in the top and we divide that by the equity plus the debt, which is represented in the total capital. And so that will in turn give us a percentage, which is expressed as the weight of equity. Now, we talked about the weight of equity, which is one part of financing. Let's talk about the other part of financing for a corporation. That's the weight of debt. Organizations will commonly take out additional sources of capital to fund their operation through the form of debt. And we see this usually through loans that can be taken out from banks or corporate bonds. There's a lot of ways to raise debt in a corporation. The most common ways are through loans, through banks, and then of course through corporate bonds. And a lot of these are tied to the corporate bonds typically have lower interest rates and longer payback periods. Debt is and just kind of like a side note, debt is typically paid back first in the event of a bankruptcy. And it lowers the risk of an investment. So I guess a current example that we could use would be J.C. Penney. They are on the verge of bankruptcy. I don't know if they've already filed, but they probably will, given the current retail climate. So what we'll see with J.C. Penney is when they declare bankruptcy, it'll provide them with an opportunity to restructure the business in a Chapter 11 setting. They'll do some liquidation. They'll restructure their current debt on their books. They'll refinance, so to speak, and subsequently they'll end up lowering the risk of investing in the company. But at the same time, they also lower the returns on the company. So if you look at the stock of JCPenney currently, I think they're trading somewhere around $1 and some change per share. So when they go into bankruptcy, what you'll find is that that dollar and some change will be dramatically reduced to probably a couple of cents on the dollar, which in turn reflects the lower risk, but also the lower return. The weight of debt is a component of the company's capital structure. It's calculated by dividing the market value of the company's debt by the sum of the market value of the company's equity and debt. So it's very similar to the other formula that we just saw for the weight of equity. The difference here is that on the top, instead of using equity, we're going to use debt. So we take the company's total debt and we divide that by the equity plus debt. Now, of course, the fun part is the cost. There's a cost associated with raising capital, whether that capital is equity or debt. When it comes to equity, as you know, equity is represented typically as shares of stock. The equity cost is calculated through the capital asset pricing model. The capital asset pricing model formula is the expected risk-free rate plus the beta, which is the sensitivity to the market risk, times RM minus RF, which is the risk premium compared to the risk-free rate. We also call this return on the market. So don't be too concerned when you see formulas that are this complex. It's just a matter of plugging in the values. And you'll see that when we get to our workbook. Now that we've talked about the cost of equity, of course, we need to talk about the cost of debt. So the cost of is in an organization, one of the options for sourcing capital is to pursue debt. This is typically done through taking out loans, corporate bonds, and they typically have lower interest rates, just as we discussed before. So the calculation is a little bit different than the capital asset pricing model overall, but it represents this same concept. So what we do to calculate the cost of debt is we take last year's end interest expense, and we divide that by the book value of debt. The book value of debt and the last year's interest expense you will be able to find on the 10K report from the previous year. And just as a reminder, if we're talking about expenses, revenue and expenses we find in the income statement, and anything related to value or related to debt, we're going to find on the balance sheet. So in this project, in addition to, in addition to the workbook, you do want to take a look at the company's 10K report. And that'll also help you, especially when it comes to your executive summary. We'll talk about that when we get to the workbook. So going back to our capital asset pricing model. The model is really used to determine the required rate of return of an asset, taking into account the asset sensitivity and non-diversible or systematic risk. So when it comes to evaluating the required return of an asset, what we're really saying is the company is worth X amount of dollars. As an investor, I would expect a return that is higher than the value because of interest, right? So it's very similar to what we discussed in Project 4 and a little bit in Project 3. With respect to the sensitivity of non-diversible or systematic risk, what we were talking about here is the inherent risk that is involved in investing. As you might expect, the risk typically is a result of a potential loss. right? And so we benchmark that using what's called the real risk-free rate, or risk-free rate, which is essentially a benchmark in terms of the overall performance. And of course, when we invest in a company, even with the original investments, we expect to gain what we call a premium on the market. So as an investor, if I want to help my investment make money, I'm going to invest at what we call a premium. And at a premium rate, I expect a premium return. And the word premium essentially means just above the market rate. So anything above the market rate, we call it a premium. Anything below the market rate, we call it a discount. And of course, all this is relative to the beta, which is the stock's relative risk, also known as sensitivity to the marketplace. So just as we talked about in the previous slides, the weighted average cost of capital is a combination of those formulas that we just discussed with respect to the weight of debt and the cost of debt plus the weight of equity and the cost of equity. We combine all of those elements into the weighted average cost of capital formula. So the calculation of the various required returns on a project, which ultimately determines the profitability required to break even. So just as you learned in Project 3, the concept of breaking even is the recouping of your initial investment. And at the time that recouping of the initial investment is reached. We'll explore this concept more in the project. With the above options in mind, the weighted average cost of capital normalizes the cost of capital by combining the interest rates being incurred from both the debt and the equity. So the total formula is written this way. We have our weight of debt, which is debt divided by debt plus equity, times KD, which is the required return on debt, plus the weight of equity, which is equity divided by debt plus equity, times KE, which is the required return on equity. Don't worry about memorizing the formula. It gets very complex, as you can see. So now that we finished step 1 with respect to the PowerPoint presentation, let's go ahead and go to our workbook. Okay, so here's the workbook. You have your cute little instructions page. It says complete the workbook. So the first thing we're going to do is go to our cost of capital tab. Scroll to the top, and there's a bunch of data provided to us to complete this part of the project. So just like you were working with in Project 4, in Project 5, we're also working with McCormick. And as we discussed in Project 4, McCormick is looking to make that initial investment of land in order to build a factory to optimize their production. And so here's some data provided to us. The company needs about $350 million for an initial investment into the project. And we're going to use 20-year bonds for that borrowing. For the past 10 years, the company has used a 7% discount rate. This was based on a study that the company did on their weighted average cost of capital model in early 2010. Interest rates have risen since the last time that they reviewed that rate. And the average interest rate was 3%. So for today, or for this project, we're going to use 4% as their interest rate. There's also been changes in the weights of debt and equity since 2010, as you might imagine. So here's a little bit of background about the company that I'm sure you probably may already know about. Recently in 2017, the company acquired Rickett Mesker Food Division, or RB Foods. That as you know, McCormick is historically been a spice company. They do a lot of different spices. Here, probably one of their most commonly known spices, especially here in Baltimore, is Old Bay. The company recently, in 2017, recently acquired a company that manufactures condiments, like French's, Frank's Red Hot, Cattleman's, which I think they primarily do, like Cattleman's, I think is like, what do you call, mayonnaise. So, which it's a very fitting acquisition, since it's kind of a complementary to their current offerings. So part of the work that McCormick is asking us to do in this project is to reformulate their capital asset pricing model. And we're also going to look at the dividend cash flow approach, and we are going to use the cash flow approach to look at the risk premium of 3 to 5%, which is being recommended by one of their board members. So let's go ahead and take a look at the questions. So the first question that's being asked of us is to figure out the capital asset pricing model cost of equity. So it says that the CFO estimates the beta to be 0.90. So the first thing you want to do is come down to question 1. And under beta, you want to enter 0.90. Okay, got that. The company wants to use 30-year bond rate as the risk-free rate, arguing that investors make long-term investments, and that rate today is 3%. So 3% would be our risk-free rate. And again, I'm getting this data directly from the question. The expected return on the stock market as a whole has been estimated to be 7%, 10%, and 12% by various studies. The CFO asks that we use an expected return of 9% on average stock. Okay, wonderful. But that's not all. The market risk premium will be 6%. Well, how did we get 6%, Dr. B? It says 9%. Well, as you recall, the formula for risk premium is the market minus the market expected return minus the risk-free rate, which in this case is 6%. 9% minus 3% is 6%. So 6%. Wonderful. Okay, lost my place. Okay, now it says to calculate the capital asset pricing model. It gives us the formula again. Required return on equity of debt, required stock in excess of risk-free rate. Blah blah blah. Nice. Wonderful. Okay, so we have our raw data. Risk-free rate 3%, market premium 6%, and the beta is 0.9. Now, according to the formula, the next step here is to multiply the beta times the market premium. So we simply go equals beta times market premium, enter, 5.4%. Wonderful. That's not all, of course. Now, also according to the formula, as it's written, is that we need to include the risk-free rate. Risk-free rate plus return on the market times the beta. So risk-free rate again, we said was equals 3%. So the capital asset pricing model, cost of equity is equals beta times the market premium plus the risk-free rate to get us to 8.4%. And that is question 1. Any questions? Question 1? We're good? Okay. All right. Wonderful. Thank you. Okay. Question 2. The dividend, the discount, I almost said dividend discount model. We talked about that in project 4. The discounted cash flow model is referred to as the direct dividend model, or DDM, in the course materials. The formula that we're using here is dividend 1, or dividend from expected for next year, divided by P of 0 with initial investment plus the growth percentage. So the required rate of return or equity cost of the cost of equity, D1 is the expected future dividend. P of O is the price of stock is worth today, plus G is the growth in dividends. The CFO notes that the expected future dividend is 2.38, so $2.38 for the future dividend. That's not too bad, honestly. It's actually a pretty decent dividend in my opinion. This data is pretty recent. It's as of March 17th. The expected growth rate is 7%. Where's my expected growth rate? Growth, 7%. Okay. Okay, so the purchase of the stock price at the close of March 17th of this year was $138.70. So $138.70. Don't worry if it rounds, but if you don't want it to round, like, because I don't really like rounding, so you can just click this little button right here, and it'll move out 2 decimal places. Okay, so the formula tells us that the first thing that we do is we take our expected dividend for next year and we divide that by the stock price today. So we go equals next year's dividend divided by today's stock price, gets us 1.72%. It's not too bad. Okay, the next part says we add that to the growth rate. Wonderful. Growth rate we said was 7%. So we go equals 1.72% plus the growth rate of 7% equals 8.72%. Now here's an interesting fun thing. Well, it's fun for me. Okay, so I'm a bit of a math nerd if you haven't been able to tell. But here's an interesting fun fact for you. You have your capital asset pricing model that we utilized in question 1. In question 2, we used the direct dividend model, also known as a discounted cash flow model. And we can see that it's very, very close in terms of the cost of equity. Now, here's the thing. You're probably wondering, well, Dr. B, why are they different? Why would the capital asset pricing model cost of equity be different than the discount cash flow model cost of equity? Shouldn't they be the same? Well, the answer is no, they're not the same. And the reason why is because the discounted cash flow model does not take into consideration risk, which it does in the capital asset pricing model. So without risk, 8.72%, with risk, 8.4%. So it's a very interesting concept, and the reason why companies like to utilize different models to understand the cost of equity and the cost of debt is to better understand the overall company structure when it comes to capital. And that gives it gives your financiers a better understanding of what they need to do in order to have a good balance between debt and equity. So just a little fun fact for you. Okay, so question 3. So this advisor who sits on the board of a private equity firm, she informed the CFO that some sophisticated investors use quick estimates for the cost of equity. Well, no surprise there. A lot of investors, they don't like to do the math. They don't want to run out the CAPM. They don't want to run out the WACC formulas. They just want estimates, right? And estimates, they're okay, but again, they're just estimates, so they're not the most accurate. So question 3, we're looking at estimates because, again, sophisticated investors like to use estimates for the cost of equity. So she says that the cost of equity must be logically higher than the company's debt, and that makes perfect sense. It's typically between 3 and 5% higher than debt. So the company estimates the current borrowing cost at about 4%. And so let's calculate our estimates, knowing that the cost of borrowing is at 4%. So we come down to question 3. We have what's called bond rate, the premium, and the cost of equity. Okay, so we were just told that the borrowing cost is 4%. That's the premium. The premium is the cost, 4%. So 4%, 4%, 4%. Now it said that we're looking at an estimated range of 3% to 5%. Okay, so bond rates of 3 to 5%, 3%, 4%, 5%. Now, what's the cost of equity? Well, as you might expect, the cost of equity, what we're doing is we're going to add in a premium to the bond rate. So it's very simple. We go equals 4% plus 3% equals 4% plus 4% equals 4% plus 5%. Well, that's interesting. So once again, we do the comparison, right? So if you look at this, in question 1, the capital asset pricing model cost of equity is 8.4%. In question 2, the discount cash flow model cost of equity, 8.72%. And in question 3, using estimates, we have a range, 7%, 8%, 9%. So as of right now, the 8%, what's right there in the middle, is the closest in terms of comparison for overall accuracy. Technically, it'd probably be somewhere between 8 and 9%, but it's just interesting to see that dynamic. Okay. Okay, so that's question 3. Any questions so far? We're good? Okay. Question 4, the weighted average cost of capital. So as we already learned, the weighted average cost of capital is the weight of debt times the weight of equity times 1 minus the tax rate plus the value of debt times value of equity. This is just another way of expressing the weighted average cost of capital. I guess you could consider this the long form. Okay, so we have some information. In order to estimate the weights of debt and equity in the total capital structure, the CFO suggests that the book value of debt and the market value of equity. To determine the book value of debt, we want to look at, this is where the 10K report comes in. Use the data from the year-end November 2019 McCormick 10K report. So as you recall from the previous projects, you go to sec.gov, you go to company filings, and McCormick is MKC, the fast search. So otherwise you'll spend quite some time trying to find it. The latest 10K report, you got to come down a little bit. You want 10K, not any of these other ones, 10K only, okay? Here it is here, 10K report, documents. Of course, it'll be your first link. It'll load up, and then on you go with your entertainment, your fun, entertaining reading. Okay, so for the sake of time, I'm not going to scroll all the way down because it'll take forever. So what I've done, just for the purposes of demonstrating this presentation, I pulled out the data for us. So calculate the weights. There's nothing will go in this first box. That first box is intended to be empty. The short-term borrowings, according to the 10K report, were $600,700. It's technically in millions if you want to be creative, which means it's about $6 billion and change, right? So $6 billion and change for short-term borrowing. Current portion of long-term debt, and of course you would get that from the balance sheet. Actually, all this comes from the balance sheet. The current proportion of long-term debt is $97,700. Expressed in millions, it would be, you know, much further out, 97 million and change. And then we have our long-term debt, which is astronomical, by the way, $3.625 billion in total long-term debt. It's a little high, in my opinion, but that's just my 2 cents on that. Okay, so $600,700 for short-term borrowings, $97,700 for current portion of long-term debt, $3,625,800 for short-term debt. Okay, what's the total debt? Well, that's simple. You just go equals sum, open parenthesis, highlight these guys, close it. There's our total debt. Or alternatively, if you don't want to do the whole sum thing, just go equals this guy plus this guy plus this guy. Do the same amount. Okay. So great, we figured that out. We got our total debt. The market cap is $18,420,000. How we got that? It was given to us right here. 18.42 billion. So since we're not going to write out the whole billion, that would be, I mean, you'll get the same result, but instead of having to force all those zeros, just bring it down in relative terms to millions, right? So 18,420,000, which is the same as saying 18.42 billion, because all of this, will, of course, would be in millions. Because when you look at the 10K report, you'll see that it's expressed in millions, which is when you see the comma, you know, when you see it rounded out this far, when it's in the millions and the report's already in millions, that means it's in billions, right? Sometimes the reports, you'll find that when companies do their reporting, especially in 10Ks, they're not all standardized. Some companies report in thousands, some report in millions, and really, it's really semantics. I mean, we're just talking about the zeros at the end, because this overall structure is still the same in the reports. It's just some report in millions, some report in thousands. McCormick just so happens to report in millions. Okay, so the total capital. The total capital, as you know, is your total debt plus your total equity. That's your total capital. That's how companies' capital works. It's equity and debt together. That's total capital. Okay, now we're going to figure out the weights of each. Well, Dr. B, how do we do that? You know how to do this. You know how to do this. The total cap, if you recall the formula for the weight of debt, we know that the weight of debt is total debt divided by equity plus debt, which is also known as total capital. So we got 19% of the weight of debt for this company. Now, onto the weight of equity. The weight of equity, as you already know, is your total equity divided by your debt plus equity, which is also known as total capital, equals 81%. Now, how do you know if it's right? How do you know if it's right? Well, as we said, total capital consists of debt, total debt and total equity for the company. We see 81% equity, 19% debt. Well, if you add those two together, it's 100%. That's when you know it's correct. If it's 100%, it's correct. It means you factored in equity and debt, or sorry, debt and equity in this case. Okay, going back to our question. Now that we extrapolated the data from the 10K report here, we calculated out total debt, total equity, and total capital. We figured out what the weight of equity and weight of debt and the weight of equity are. The question is asking us to calculate the capital asset pricing model, right? So as you know, capital asset pricing model, here's the, I'm sorry, weighted average cost of capital. We're looking for the weighted average cost of capital. As you know, the weighted average cost of capital formula is given to us here. So we figured out the weight of debt. We figured out the weight of equity. Now we got to figure out the tax. What's the tax? Well, it says that the company tax rate is 27.5%. So tax rate, 27.5%. Okay, great. So after tax cost of debt. Okay, how do I get after tax cost of debt? Okay, so here's how we do it. Okay, so let's think about this first. When we look at the tax rate, we know it's 27.5%. We look at the formula, we got 1 minus t, okay? So we just got to keep that in mind when we complete this part, yeah? So I guess in theory, you could do that. But no, let's not do that. Okay, let's do it this way. After tax cost of debt. So here's what you do. You take your total debt, your $4,324,200,000, and we are going to multiply this guy . Well, hold on before we do that. We have our debt interest rate. I don't even know if did we talk about that? I don't think we did. Okay. So the debt interest rate, how do we get this 4%? Should see here. Oh, here it is. Probably should have read the rest of the question, right, before we went ahead. Okay, so determine market value of equity. Here's the following data, March 17th. We took our equity amount, 18.42 billion, as we saw. 4% for the cost of debt, 27.5% for the tax rate, which is a combination of federal and state. Make your own best estimate of the cost of equity based on the work in questions 1, 2, and 3. Okay. So after tax cost of debt, here we go. So I guess there's really more than one thing you got to do first, because we have a debt interest rate. So if we were to take our total debt, multiply that guy to the debt interest rate, okay. We add back in our total debt. That should get us the total debt plus the interest, okay? So if we then go oh, that's clearly not it. Well, I guess what I'm trying to do here is some side calculation. So if you let's do it this way. What I'm trying to do here is take the total debt and add in the debt interest, right? Because that gives us our pre-tax debt amount. Then we got our taxes, right? So our taxes, the total amount we're going to pay in tax is going to be $1 million and change, which gives me an after-tax cost of debt equals this guy minus the taxes. There we go. So our after-tax cost of debt we find to be $3,260,466,800. Okay, so that's our after-tax cost of debt. And again, how we got there. So I'm sure I probably went a little bit, well, maybe I went too slow, but so how we got the after-tax cost of debt. We took our total, first we had to figure out how much it would be pre-tax. It says that we have a debt interest rate of 4%, okay? So I took our total debt and we figured out the 4% and we added back in the debt to get the total debt plus the 4% interest, which is 4.497,168. Then we figured out, well, how much is going to be taken out in taxes. Now, how we did that is we took the pre-tax amount after the debt interest rate was added in times the tax rate to figure out that in taxes, the company will end up paying $1,236,721. And to get the after-tax cost of debt, we take our pre-tax amount minus the tax to get the after-tax cost of debt. Does it make sense? Yes? Okay. Okay, now of course we got to figure out cost of equity. What's cost of equity? So cost of equity. What do we think? Cost of equity. Okay, so let's look cost of equity. Cost of equity, as you know, is the equity divided by the total capital. So if we go equals equity divided by total capital. Okay. Oh, let's get the percentage. What are we doing here, B? What are we doing? Oh, I guess we do this. There we go. So just take your total capital, multiply that by your weight of equity to get your cost of equity. Makes perfect sense. Oh, wait a second. No, it doesn't, because it's the same. It's the same. Hold on. We got cost of equity. This one wasn't given to us. We got cost of equity. Okay. Oh, sorry. You know, I got to keep reading the whole sentence. Make your own best estimate of the cost of equity based on your work in questions 1, 2, and 3. Okay. So cost of equity, we're not gonna take that data from question 4. So cost of equity. Oh, this one's a little bit easier. Okay. So looking at questions 1, 2, and 3, make your own best estimate of the cost of equity based on your work in questions 1, 2, and 3. Question 1, our cost of equity was 8.4%. Question 2, our cost of equity was 8.72%. And question 3 is 8%. Well, we have 7, 8, and 9. So my best estimate, looking at these 3 models, 8.4, 7.2, 7, 8, and 9, I'm going to go with 8%. And the reason why I'm going to go with 8% is simply because it is the closest out of the range. You got 9, you got 7, you got 8. We can see that when we average, if we were to average all these together, it'll be a little bit higher than 8, but not by much. So let's go with 8%. I think 8% is going to be the best cost of equity based off of these estimates. So let's go 8%. Okay. Percentage. Okay. Now here we go. Let's go into the terms. So we're getting down into the formula now. We pulled out all the data. We figured out the weights for debt and equity. We figured out the after-tax cost of debt. We gave an estimate for the cost of equity, 8%. Now, the terms: debt term, equity term, weighted average cost of capital. So looking at the formula. So the debt term, the equity term, to get us the weighted average cost of capital. So the debt term, we got the the value of the debt times value of the equity times 1 minus the tax rate. So value of debt, value of equity, 1 minus the tax rate, equals let's do open parenthesis. The question of the day is, do we take the debt, the total debt before? No. Well, you could. Well, because then we factor in the tax, so that answer would be no. So the value, it said value debt, right? So the weighted debt divided by, okay, yeah, great, great, great. So the value of the debt, which is also, you know, wait a second. Yeah, the value of debt, which is the weighted debt, right? So we got the weighted debt times the cost of debt. Okay. I'm sorry, what did I do there? So we got the weighted debt times the cost of debt. There's my cost of debt. Cost of debt. Weighted debt times the cost of debt times 1 minus the interest rate. Close. We don't close it again. Yeah, we close it again. Okay. Whoa, that's a little high. What I do? Weighted debt times, oh, it's because I did after tax cost of debt. I didn't want to do that. Did I? Did I want to do? Yeah, no, I didn't want to do that. Okay, let's go back. What's causing it to do that? Is it the form? I think it's the form. 1 minus the tax rate. What was it? Plus. I don't know. What's causing it to do that? It's kind of strange. Okay, we'll get there. Now let's do equity. It should balance out. Okay, let's see. So weighted equity times cost of equity equals weighted equity times cost of equity. Well, it clearly cannot be. I think something funny must have happened in that debt term formula, because that doesn't make any sense. It certainly would not be that high. Okay, let's see what happened in this debt term formula. The equity one's easy. You're just taking the weight. Oh, what did I do? I didn't add that. I did multiply it, right? Yeah, multiply it. Okay. So the equity part's easy. You just take the weight of equity times the cost of equity. The debt term. Now, what happened here? So strange. What if it was that 1 minus the tax rate part? Let's see. Weighted debt times cost of debt. Actually, you know what? Okay, so that's where it's acting up. So that just doesn't make any sense. Huh. I think it's probably a formatting issue that's causing it to do that. But why? Any thoughts? Recommendations? What am I doing wrong?
So, Professor, just a wild guess again. When you look at the formula for the cost of equity, you're doing it's percentages, but when we're doing the debt term, we're multiplying it times that large after-tax cost of debt.
Right.
So I'm just wondering, questioning, is that right? Or are we supposed to do the debt interest rate times the tax rate?
Oh, there you Well, actually, let's think about that for a second. Okay. So what you're saying is that the order of operations is not accurate.
Well, not necessarily the order of operation, but the numbers that we're considering, because I kind of moved the formula down on the spreadsheet as you're working and we're working together. And I can't say that I need to kind of drill in and understand it a little bit better, but if you're looking at the weights, they're both percentages, right? So
Correct.
if you go back to the debt formula, you actually leverage that after tax cost of debt, so that 3.2.
Uh-huh.
But should we instead consider the weight? So, and again, this is a guess. So the 27.5% times the 4% times 1 minus the tax rate. Because when I did that, it came up to a percentage.
Yes. Okay, I see what you're saying. Okay, so walk me through it. Let's walk through it together.
So what I did is that the weight, so that 19, and let me highlight here. So I did the 19%
Uh-huh.
times 4%
Times 4%. Okay.
times 1 minus the 27.5%.
Like this?
Oh, but the brackets, you still need your brackets.
Oh, oh yeah, I see what you're saying. Okay.
So,
Oh, okay. I see. Okay. Okay. So
and
what
then
else?
if you close, so the C79 times the C81, I put brackets to close that. So the order of operation takes there first, right?
Got it. Yep. Makes sense.
Okay.
Oh, I see. Okay.
And then that should be the formula. Just need to make sure that your brackets are there. I think you need one more bracket to close it.
To close it. Yep.
Yeah, and then, yeah, that should be it. And then I got a percentage of 0.55.
That's it. Yep. That's it. Okay. Makes perfect sense. Yes. Yes, that is correct.
Okay, perfect.
Okay, wonderful. Very, very good. Thank you for walking me through that. I would have been lost forever.
You're welcome.
I was thinking about the old, there's more than one way to do weighted average cost of capital, but I was thinking about the older way, the way that we used to do it, when we would take the weight of equity times we would take the cost of equity times the cost of debt plus the weight of equity, weight of equity times the cost of equity plus the weight of debt times the cost of debt times 1 minus the tax rate, which is, it's just structured a little bit differently, but we get to the same place. And of course, the weighted average cost of capital is we just take our equity term plus our debt term to get to 7.3%. So again, another interesting difference. So we see here. So the capital asset pricing model shows 8.4% the weighted average cost of capital showing 7.3%. So the thing that makes these two most different really comes down to the risk. And of course the premium. So if you didn't have the premium, I mean, they'd be really, really close. Interesting. Very cool. That was fun. Let's do it again sometime. Okay, so step 2. Making decisions. Oh my goodness. Okay, so don't worry. It gets more complex, but it's okay. We're here. We got this. All right. So let's take a look. We got when we in business decide to purchase a building or equipment or something of a tangible asset, the wonderful folks at the Internal Revenue Service have developed what we call a modified accelerated cost recovery system, which essentially tells us the amount of depreciation each year for a specific time frame of the asset's useful life. And so let's break that down just a little bit further. So think of it this way. let's say we're a construction company and we purchased a dump truck. The dump truck cost $25,000, and the IRS says that the useful life of a dump truck is 5 years. Now, with the modified accelerated cost recovery system, the first year depreciation might be like 27%. The next year might be 16.4%. The following year might be like 12%. The following year would be 8%, so forth and so on until we reach a value of 0, at which point the vehicle, the useful life is there. So the IRS publishes these tables in order to help us to utilize what we call double declining balance for the acceleration of depreciation. Now, why would we want to accelerate depreciation, you might ask? Well, it's for tax purposes. So the companies, what they like to do after they purchase a lot of equipment is we want to write that off straight away. So what we do is we would utilize the maker's model in order to get the greatest benefit from depreciation. So because we're able to deduct depreciation in the taxes. And we'll talk a little bit more about that when we get into the workbook. So let's talk about cash flow. As you know, cash flow stems from revenue from customers and expenses going out. So like a net cash flow would be, we have revenue coming in and then we have bills going out. So cash coming in from customers, cash going out from day-to-day operations will get us to net cash flow. So So your cash coming in from customers, cash going out for paying bills, gets you net cash flow, just like it does in your personal life, right? In business, at the end of the useful life of a piece of equipment, we have what's called salvage value. It's similar to what you might expect the word salvage to mean. You know, it's the value of the asset at the end of its useful life. So there's cash flow associated with that salvage. So that calculation is the expected value of equipment before tax minus the marginal tax rate times the expected value of the equipment before tax minus the marginal tax rate. You might be saying, well, why would you do it into itself? Well, the reason for this is because the salvage cash flow, the value is expected to be much less than the original value of the asset. So we'll talk a little bit more about that as well. It's really for depreciation reasons. So let's talk about operating cash flow. So again, it's cash coming in and cash going out for expenses. It's a little bit more complicated than that, but so every month the business has cash coming in and cash going out. But then there's that little thing in between that we have to account for, and that we call that taxes. So for the sales that we're generating and the expenses that we're paying, we have taxes to pay at the end based off of our earnings, right? And so we generate what we call operating cash flow. Operating cash flow is a little bit different than just cash flow. Operating cash flow really tells us the monies that we have to utilize to reinvest into the business or to make other decisions. And so to calculate the operating cash flow, we take our sales minus our costs times 1 minus the marginal tax rate plus any outstanding debt times the marginal tax rate. And that gives us our operating cash flow. And again, operating cash flow is something that we actually use in business in order to purchase things, usually important things. But we use it for operations of day-to-day business. Oh, and this fun, lovely slide comes back again. So as you know, McCormick is looking to purchase the land. But on the land, they want to put a factory on it. And of course, they're going to estimate the useful life of that investment through the concept of net present value. And so as you recall from the previous project, net present value is calculated by looking at the net cash flows of the firm, and at which point we've established break even, and we've established an internal rate of return. Is the project worth an investment? If the net present value is greater than 0, then we accept the project. Don't worry about the formula. I just want to reemphasize what it looks like. Again, I'm sure you have all loved this formula by now. But again, this represents net present value for an initial investment. And then, of course, we have the net present value over a series of cash flows. So minus the initial investment plus net cash flow 1, net cash flow 2, net cash flow infinity, divided by 1 plus the rate of return, so forth and so on. And I'll show you what that looks like graphically when we get to the workbook. And of course, your internal rate of return is a metric utilized to establish an internal rate to ensure the return on the initial investment, just like we talked about in the previous project. In capital budgeting, we typically look at both net present value and internal rate of return, and we compare the two. Anytime we see that net present value is greater than the internal rate of return, we tend to accept the project. Sometimes it's not known. So if the net present value isn't known, then we would use the internal rate of return in its place to gauge the project's feasibility. Okay, so let's jump into the workbook. Step 2. Okay, so just like we talked about in the previous project, the company is looking to purchase a piece of land for $4.424 million. The factory requires an initial investment of $350 million to build the plant and purchase equipment. You've been asked to continue your work from Project 4 with full analysis of the proposed factory, including startup costs, projected net cash flow from operations, tax implications from depreciation, and the cash flow impacts of the changes in working capital. Investment will be depreciated using the maker's modified asset cost recovery system for a 7-year class asset. In other words, our friends at the IRS have determined that the building and the equipment will depreciate within 7 years. Fully depreciate within 7 years. Of course, the building's going to be longer than 7 years, but for tax purposes, we can only deduct 7 years worth. So the company will also need to finance some cash to fund $17 million in accounts receivable, $14 million in inventory starting at year 0. The company expects vendors to give free credit on purchases of $15 million of accounts payable. The CFO wants to consider the net cash outflows for working capital as well as the cash outflows for the property, plant, and equipment at year 0. Note that $17 million for accounts receivable, $14 million for inventory cash outflows. The $15 million accounts payable is a cash inflow. Okay, CFO has indicated that net working capital will be received. Will be recovered cash flow in year 21. She also estimates the company will be able to sell the factory equipment and land in year 21 for $40 million. We call that salvage. Okay, so question 1. What will be the depreciation for tax purposes each year? Complete table 1 below to answer this question. Now remember that the initial investment is $350 million for the plant and the equipment. And land in itself does not depreciate. So land never depreciates. Only buildings and equipment will depreciate. The dirt itself doesn't have depreciation because it doesn't have it's classified as infinite. Okay, so let's look at the depreciation schedule. So according to the maker's report, 7-year class, this is the percentages at which the asset will depreciate over time. Okay, so how do we figure this out? The initial investment, 350 million. We multiply the 350 by the percentage classified in depreciation to get the amount being depreciated for that respective year. The first year, we expect to depreciate 50.02 million. The following year will be 85.72 million. Year 4 will be 43.72 million. So how do we, you're saying, Dr. B, how do we fill in the chart? Well, it's simple. You can either go like this, you go equals 350 times the respective percentage of depreciation, or you can just simply select that first one, click on that little notch, and drag it on down. Oh, maybe not. What happened? Oh, you know why? It's probably because I dragged over those. Let's just make sure that that's correct. Equals 350 times this guy. No, that's not correct. So what happened there? It's kind of strange. Oh, you know why? I didn't fix the I didn't put the fix on that. Okay, so you can either just simply do 350 times the percentage, or you could do equals 350 times the percentage. But for that D51, just put the little dollar signs in between the D and the 51. What that does is it locks the cell reference in place. That's what was happening before, was it wasn't locking the cell. Okay, so now question 1 is complete. You'll see why we did that when we get to question 2. Question 2, create an after-tax cash flow timeline for the proposed factory using table 2. The CFO estimates that the operations for the company will be profitable for an ongoing basis. As a result, any accounting loss for the specific project will provide a tax benefit for the company overall year loss. So as you might expect, when a company loses money in a given year, they typically don't pay tax for that given year, because how can you pay tax on a loss, right? Okay, so your workbook does not have this part. I pulled some data out. And I pulled this data directly from up here, okay, from this information. Property, plant, and equipment, we said it was 350 million. The land is 4.424 million. Accounts receivable, which we're going to utilize to finance some of the operations, is 17 million, so minus 17 million. Inventory, initial purchase of inventory is going to be 14 million outflow. And then our vendors are so kind enough to give us a credit of 15 million to get started. So, of course, we got to figure out what is the expected cash outflow for that for year 0. So what we do is we take a sum of the initial investment. And at year 0, we expect a net cash outflow of 370 million. Of course, that would be in expenses, right? And in year 0, of course, there's no tax, there's no depreciation, because it hasn't happened yet. This is just the initial setup. The purchase of the plant and equipment, purchase of the land, financing using accounts receivable, purchase of initial inventory, and a credit from our vendors. Okay, so that's year 0. You want to make sure you have that information there. Very important that you have year 0 in there. Okay. And again, there is no depreciation year 0, no taxable income because we're not operating yet, and there's no taxation year 0. There is, however, in the following years because that's when we start operating, or we expect to start operating year 1. Year 1 cash inflow 1.8 million, outflow 1.728 million. Our depreciation, as we said, from year 1 was 50.02. The taxable income, to find taxable income, you take your revenue minus your expenses and minus your depreciation to get to taxable income. The tax rate is 27.5%, which we learned from the first tab. So you take your taxable income times 27.5% to get the total tax. And of course, your after tax, we would take your revenue minus your expense minus your tax. The reason why we don't include depreciation in the after-tax cash flow is because we're already taking the depreciation into consideration for taxable income. Otherwise, you'd be creating double taxation. So, simple way of completing this chart. What we want to do is, and keep this in mind, the depreciation we said ends using a 7-year class. Let's see here. Yeah, depreciation using the 7-year class, we expect to end there. We'd say 7 years, right? Yeah, 7-year class asset. Let's just make sure that equals the 350. Yeah, okay. So the depreciation we know will end at year 8. So here's the simplest way to do it. Drag this guy down all the way to year 8. Now, here's the thing. At the end of year 8, we've fully depreciated the 350. We don't depreciate the full 370 because, remember, land is not depreciable. Receivables, inventory, accounts payable, none of that depreciates. Only the property, only the plant and the equipment depreciate. So you depreciate up to your 350 million, and then after that, it's 0. 0. Okay, so the best way to do it is just take your 0, drag that all the way down to your 21. Okay. The rest of it, the taxable, the rest of it, you can just take these guys and drag on down. Okay, now we got the year 20. Great. So, but Dr. B, there's 21 years. Okay, so how we got there 21 years? Now remember, in the data, it said that in year 21, we expect that we're going to sell the factory equipment and land in year 21 for about 40 million. Okay, so we'll sell these two guys for 40 million. We're going to pay our receivables back. We're going to pay back our initial inventory, and we're going to pay back our vendors for the initial investment in year 0. So our total cash outflow at the end of year 21 equals sum year 21, 56 million. Okay. Now, of course, we expect to get, the 40 million and pay back everything else. Year 21, we're not terribly concerned about that. just yet, but as you might expect, if we're going to get revenue coming in, regardless of how we got it, through the sale of equipment or whatever, of course, there's going to be tax on it, right? Unfortunately, there's going to be tax on it. So year 21, there's no revenue, so that's zero. 56 million. Actually, no, that's not correct. My apologies. The 56 million is actually is coming in. The outflow. I don't know why it says 53. Where's that coming from? It's kind of weird. I don't know where that 0.96 is kind of weird. Well, that should be zero, yeah. I'm sorry. The outflow should be zero. There we go. Okay. Yeah, very good. Okay. So so that's question 2. We're all good. Question 2. Question 3, calculate net present value and IRR using the data from question 2. Should the project be accepted? Okay, great. So net present value, here we go. Function, NPV, okay. Our rate, and our values. Okay, what's our rate? Does anyone remember what our rate is? What's our rate? Let's see, what's our rate? I don't think I overread it. Did I overread it? No. What's our rate? What do you think our rate is? It's not the tax rate. So discount rate over the length of one period. Discount rate, one period. What do you think our rate is? Anyone? Discount rate. Pulled from project 4. Could, or discount rate over one period. So that's discount rate, one period. You could pull from project 4, or what? Discount rate over one period. Now, if I remember right, let's see here. Let's see if I remember right. What's our rate? I thought the rate was 8%, but I could be wrong. What was that rate? Hold on just one second. Oh, That's not what I meant to do. What is that rate? Hold on just 1 second. And you had said, can we pull the rate from project 4? Can we pull the rate from project 4? Oh, sorry. Accidentally clicked the share button off.
So the discount rate on the first tab under cost of capital, it
Yes.
says the company has used 7% as a discount
There
rate.
it is.
But is it 7%?
7%. You're correct. It's 7%. Yep, it is 7%. So, discount rate 7%. In that case, NPV, the rate is 7%, as you said. And that is definitely correct. I made sure of it. The values. Okay, so as you know, net present value is your after-tax cash flows. And you want to make sure that we take the values from year 0 all the way through 21. Okay. Now let's look at the internal rate of return. IRR. Values of the array from the series of cash flows. Beautiful. Well, that was a lot easier than I expected it to be. Any questions? I knew that discount rate was somewhere on that first tab. That's why I went back there. I just couldn't remember where it was. It's been a while since I've done this project. Okay. Question 4. We're almost there. Yay. Okay, question 4. CFO is particularly concerned with the potential impact of the future tax increases that the expenses may have been systematically understated. Oh, okay, that's a bit of a problem. You know, just like when we do projections for any project, we always run that risk of understating our expenses and what happens like when we make more money and let's say that there's a legislation change and the taxes go up. So of course it's always good to create a model with those assumptions. So in order to undertake our objective evaluation, we're asked to prepare a second analysis using these assumptions that the tax rate will increase to 50%. That's, of course, a combination of both federal and state taxes. And we expect the expenses will be 2% higher. Okay. And we expect that these changes might happen in year 4. Okay, so what we'll do is we'll redo our table to include these assumptions. So, so just as we've done before, year 0, we have our cash outflow of the 370. We have, okay, we got our tax outflow of 370. I'm sorry, our total year 0 outflow of 370. And our inflow of 56. Year 21. We just got to make sure you do that first. Okay, great. Now let's go down. So it said that our let's see here. What should happen? Calculations, expenses, and your come 2% higher than the estimated for the entire life of the project. And the tax rate increases 50% in year 4. Okay, these are good assumptions. So what you'll see here is that in the formula, what we did is we took our cash flow from table 2 and we multiplied that by 1.02. to represent a 2% increase in the expenses. So quite simply, just go ahead and take that and drag it on down. Okay. The depreciation, as you know, goes through year, let's say D53. Where's that pulling from? Three pulling from, oh, it is D. I'm sorry. I'm starting to lose my mind. Okay, so the depreciation goes through and ends at some point, so just go ahead and drag that all the way down. Oh, maybe not all the way down. Most of the way down. Depreciation follows through to year 8. And then after that, it's all zeros. Oh, why did you do that? All zeros, rest of the way down. Okay, great. Okay, taxable income. And that's the same formula. We take our cash inflow minus the cash outflow minus depreciation to get taxable income. Let's go ahead and drag that on all the way down. Okay, and then our taxes are 27.5%, and then said up until year 4. Year 4 changes to 50%. So 27.5. Then in year 4, right, so don't drag over year 4 because that'll have some trouble. Year 4 taxes go up to 50%. Just drag that all the way down. Okay, and then of course our after-tax cash flow is our revenue minus expenses minus the taxation. Drag that all the way down. And wonderful. Question 4 is now complete. Now question 5. Calculate net present value and IRR using table 3. So function, net present value. The rate we said was 7%, right? It was 7%. I hope it's 7%, right? 7%? Just make sure. Yes. Discount rate 7%. Wonderful, thank you. Net present value, rate 7%. The value range. Okay. And the IRR. Well, this is interesting. This is interesting. Okay, so here's what we're seeing. Yeah, it's a very dramatic shift, and I think that we would expect this type of change, especially when your expenses are underestimated by 2%, and your taxation is underestimated by like 28%, right? So that's a serious difference. So question 5 is asking, calculate NPV/IRR, we just did. Now, question 6, this is open-ended question, okay? It says, considering all of your work in questions 1 through 5, should the project be accepted? Discuss the risk and potential reward for the project. Okay, so fascinating. Under the assumptions that we went through in question 2, and based off of the NPV/IRR we got in question 3, yeah, the project's worth it. Questions, but if the assumptions in question 4 are correct with NPV/IRR question 5, then no, it's not worth it. So so you might be asking yourself, well, Dr. B, how do I figure out whether it's a good investment or not? Well, what we do is we run out different models, different theories. So there's a couple of good ways you can do this mathematically, but when you're looking at two potential situations. You can simply take the difference between the two net present values, right? You take the difference between the two net present values, realize that it's still overall positive. Hopefully the tax rate doesn't go up to 50%. Otherwise, it could run into this issue. Difference between IRR. This is always a fun one as well. So it's interesting. So question 6 is an open-ended question. You can answer that however you please. Just make sure that you support your answer. There's risk and reward with either decision. If we don't do it, then we save the money. If we do it, we risk it, but at the same time, our reward could be a very large revenue generation. So yeah, it's a challenging question, absolutely. So that's the workbook. Questions? Good. Okay. Now let's wrap up the project, shall we? We only got a few more slides left. Okay. Step 3 will be a discussion on capital budgeting. So in capital budgeting, as we talked about, the idea is that we utilize our equity and debt formula in order to finance the company's overall operations, to structure the entire entire capital structure of the business. And of course, this type of capital structure will help us in terms of making investment decisions and things like property, plant, and equipment. That's the concept of capital budgeting, is that we utilize our revenues through equity and debt in order to make investment decisions like property, plant, and equipment, which is the concept of capital budgeting. So that'll be your discussion that you'll have next week. And of course, with every project, we have an executive summary. And just as before, you really want your recommendations to be driven by your results and analysis. And of course, you want your results and analysis to be driven from your analysis of the problem, right? And so just as before, make sure that you include as much numerical data from the project as possible that supports your qualitative response. We want to make sure that, and this is the same with any business, anytime that you go to your employer with a recommendation, the employer will ask, well, how did you get this recommendation? And then you show them the data that you analyzed and the results of that analysis. That helps to provide a solid foundation for the recommendations that you're making. And that's why we go through these exercises, especially in quantitative environments, such as what you're learning about in this course. All of our recommendations are data-driven. And the last step of the project, just as we talked about in Project 1, you recall that you did a skills gap analysis. That was the very first thing that you did in this course 9 weeks ago. And we end the course with the same document. So what you'll do is you'll revisit the skills gap analysis that you completed in Project 1, and you'll complete that second tab of the workbook, which says Project 5 on it. And what you'll do is you'll reevaluate your overall perception of the skills that you've gained from this course, and you'll make a determination of the importance as well. And you'll write up a nice little reflection that basically summarizes how you've worked to reduce the gaps that you originally identified in the beginning of the course. And so really what that tells us is it shows us how we've developed overall. And again, this concept is employed in a workplace oftentimes through those annual performance reviews that every company seems to love to do. But the reason why they do it is to demonstrate that your overall knowledge, skills, and abilities are improving over time. It's the whole concept. And that's what learning is all about, right? So that, of course, brings us to the end of MBA 620. So my question to all of you is, well, what does financial decision making mean to you? And, this kind of question can be answered in multiple ways. It helps me understanding how to make financial decisions will help me with my employer. They'll help me in my personal life. They'll help me to make it be a better manager, make better decisions. And of course, at the end of the course, if you wouldn't mind, please complete the course survey. That helps me as a professor to grow in my craft, and it also helps the university to improve our way that we deliver the course. And my friends, that brings us to the end of MBA 620. Are there any comments, questions, concerns that I can help to address at this time? Does it all make sense?
No, not right now.
No, not okay. That's fine. Yeah, if you, as always, if you have any questions, comments, or concerns that you think you can think of later on, feel free to email me. I'm always reachable by email, and you all know that by now, right? Also, it's been a great time. It really has been a wonderful semester with all of you. I've really enjoyed it. I think that we got a solid group here, and I think that you all are really gaining some knowledge from this course. So I just want to say thank you to all of you. It's really been a really wonderful time together this semester. So with that, if you don't have any other questions or comments, I would like to call it a night, and I'm sure you all would like to as well. So thank you as well, Shauna, Kaya, Giselle. You all have been wonderful, and I really appreciate you all. And I hope that this has been a really great class for you, and definitely stay in touch. As you know, I work full-time here at the university, so I'm always around. And I plan on hopefully seeing you all at your graduation at some point in the future. The next class that you'll have from here is MBA 630, which is a law course. A lot of writing in there, law, business law. I think they call it something legal environment or something. It's a law course. MBA 640 is marketing. MBA 670 is strategy. That's the capstone course. 670 is when you'll see some of these concepts again, like break even, financial analysis, that type of stuff. You'll see it again in 670. It won't be that much. I think it's like one project, but it's fun. It's a fun course. So I wish you all the best with the rest of your program, and definitely stay in touch again for sure. I like staying in touch with my students. So, okay. Well, if there's nothing else, I'd love to call it an evening, and I thank you all so very much, and I hope you enjoy the rest of your day.
You as well. Thank you.
Thank you so much.
Thank you. Have a great night.
You too. All right. Take care.